For decades, the global banking system operated under a framework that quietly rewarded paper promises over tangible assets, allowing financial institutions to leverage synthetic gold markets, derivative exposure, and unallocated positions as substitutes for real physical metal. But the implementation of the final phase of the Basel III banking regulations fundamentally altered that structure by redefining the treatment of allocated physical gold within the international banking system, creating a historic shift in how liquidity, counterparty risk, and balance sheet stability are measured among major financial institutions. And while mainstream media coverage largely ignored the magnitude of these changes, institutional insiders immediately recognized that Basel III represented far more than a technical regulatory adjustment because it directly challenged the profitability model that many bullion banks had relied upon for decades, particularly the practice of using leveraged paper contracts to suppress balance sheet costs while maintaining exposure to the precious metals market without holding significant quantities of physical bullion. And as these new rules began taking effect across Europe, the United Kingdom, and eventually the broader international banking structure, the implications became impossible to ignore because allocated physical gold was granted Tier 1 high-quality liquid asset treatment under specific conditions, meaning that for the first time in modern banking history, real physical bullion stored and fully allocated to the owner could stand beside sovereign debt and cash equivalents as a premium reserve asset, dramatically increasing the strategic value of physical metal while simultaneously reducing the attractiveness of unallocated paper claims that carried elevated counterparty risk and unfavorable net stable funding ratios, forcing banks to reevaluate their exposure models, liquidity strategies, and precious metal inventories at a scale not witnessed since the collapse of the Bretton Woods monetary system. The true significance of Basel III lies not merely in the wording of the regulations, but in the unavoidable behavioral transformation it imposes on the banking sector. Because under the net stable funding ratio requirements, unallocated gold liabilities suddenly became extremely expensive for banks to maintain, requiring substantially more stable funding to support positions that had historically been operated with minimal capital backing. And this development struck directly at the heart of the London bullion market, where massive quantities of synthetic gold contracts have long traded daily despite representing claims far exceeding the available supply of deliverable physical metal, creating a highly leveraged structure dependent on confidence, rollover mechanisms, and the assumption that most participants would settle in cash rather than demand actual bullion delivery. But Basel III disrupted that assumption by incentivizing banks to reduce dependence on unallocated liabilities while increasing their preference for allocated holdings, effectively shifting the financial reward system toward physical ownership instead of paper exposure. And as institutions gradually adapted to these requirements, market observers began witnessing unusual movements in bullion inventories, rising demand for physical delivery, and increasing divergence between paper market pricing behavior and the underlying supply dynamics in the real-world bullion market, particularly as central banks accelerated their own gold accumulation programs at the fastest pace seen in generations, signaling that sovereign monetary authorities themselves were preparing for a world in which trust in fiat liquidity, government debt sustainability, and traditional reserve structures may become increasingly unstable under mounting inflationary pressure, geopolitical fragmentation, and expanding sovereign debt burdens that continue to threaten long-term confidence in the existing financial order. What makes this transition especially critical is the timing, because Basel III emerged during a period when the global economy was already entering a structurally fragile environment characterized by persistent inflation risks, deteriorating sovereign balance sheets, escalating geopolitical tensions, weakening confidence in reserve currencies, and a rapidly accelerating de-dollarization movement among emerging economies seeking alternatives to the Western financial system. And within that context, physical gold regained strategic importance, not simply as a commodity, but as a neutral reserve asset free from counterparty risk, political liability, and digital dependency, causing major institutional players to reassess the role precious metals must play in future liquidity frameworks, collateral systems, and monetary stability mechanisms, while commercial banks faced mounting pressure to strengthen the quality of their reserves in anticipation of tighter regulatory scrutiny and increased systemic volatility. And the consequence of this convergence became increasingly visible through rising physical demand from central banks, sovereign wealth funds, institutional investors, and high-net-worth capital-seeking refuge from the growing instability embedded within global debt markets, especially as governments continued expanding fiscal deficits, while central banks struggled to balance inflation control against the threat of economic contraction, creating a dangerous environment in which traditional fixed-income assets no longer provided the security they once offered, thereby elevating the strategic relevance of tangible reserve assets with no default risk and finite supply, And Basel III effectively institutionalized that reality by embedding physical gold more deeply into the architecture of modern banking regulation than at any point in recent financial history. Behind closed doors, many institutional analysts increasingly view Basel III not as an isolated regulatory adjustment, but as part of a broader monetary transition already underway, beneath the surface of global finance, because the international system appears to be gradually moving away from an era dominated entirely by debt-based liquidity and toward a hybrid structure where tangible reserve assets regain prominence alongside digital financial infrastructure. And within that transition, physical gold occupies a uniquely powerful position because it simultaneously functions as a reserve asset, inflation hedge, geopolitical neutralizer, and confidence anchor during periods of systemic uncertainty, which explains why central banks across Asia, the Middle East, Eastern Europe, and even portions of the Western Alliance have accelerated bullion acquisitions despite public narratives continuing to emphasize fiat currency dominance, while private banking institutions now face growing pressure to secure physical inventory capable of satisfying both regulatory requirements and rising client demand for allocated ownership structures, particularly as awareness spreads regarding the structural vulnerabilities embedded within leveraged paper markets. And this is precisely why Basel III may ultimately be remembered as the moment the global banking system quietly acknowledged that physical bullion once again matters at the highest levels of monetary power, because when regulators begin assigning premium liquidity treatment to tangible gold holdings while simultaneously penalizing synthetic exposure, the message becomes unmistakably clear that trust alone is no longer considered sufficient protection against the risks building inside the modern financial system. And as more institutions adjust to this reality, the competition for available physical supply could intensify dramatically, potentially reshaping not only bullion pricing mechanisms, but also the future balance of power within international finance itself. As the Basel III framework continues reshaping institutional behavior, the most important development is not the immediate price movement of gold or silver, but the structural migration occurring beneath the surface of global finance, because the modern bullion market was built upon an extraordinary imbalance between paper claims and actual physical inventory, allowing large financial institutions to create enormous synthetic exposure through futures contracts, swaps, forwards, and unallocated accounts that often represented dozens or even hundreds of claims against a relatively limited quantity of real metal. And for many years, this structure functioned efficiently because most market participants never intended to take delivery, instead treating precious metals as financial instruments rather than tangible reserve assets. But Basel III introduced a regulatory environment in which the distinction between paper exposure and allocated ownership suddenly became critically important, particularly through the net stable funding ratio mechanism that effectively penalizes banks for maintaining large volumes of unallocated liabilities without stable long-term funding support, thereby increasing the capital burden associated with synthetic bullion operations and incentivizing institutions to either reduce paper exposure or strengthen their physical holdings. And this transformation carries enormous implications because it threatens the profitability and scalability of the highly leveraged paper market model that has dominated global precious metals trading for decades. One of the clearest signs of this transition can be observed in the changing behavior of central banks, which have accelerated gold purchases at a historic pace while simultaneously reducing dependence on Western reserve assets and U.S. Treasury exposure, indicating a growing recognition among sovereign monetary authorities that the existing debt-based monetary framework may be entering a period of prolonged instability driven by excessive leverage, geopolitical fragmentation, and declining confidence in fiat purchasing power. And this trend is particularly significant because central banks possess access to information, liquidity analysis, and long-term strategic forecasting capabilities far beyond those available to ordinary investors, meaning their aggressive accumulation of physical bullion likely reflects deeper concerns regarding the future resilience of the international monetary system, especially as global debt levels continue expanding faster than productive economic growth, while inflationary pressures remain structurally embedded within energy markets, supply chains, and fiscal policy, creating conditions in which traditional reserve assets increasingly fail to provide the stability they once guaranteed. And within this environment, gold regains relevance not merely as a speculative investment, but as a strategic reserve instrument capable of functioning independently from sovereign liabilities, digital infrastructure vulnerabilities, and counterparty risk exposure, which aligns directly with the regulatory philosophy underpinning Basel III's treatment of allocated bullion as a higher quality balance sheet asset. The consequences of these changes extend far beyond the gold market itself, because Basel III may ultimately accelerate a broader revaluation of tangible assets across the financial system, particularly as institutions begin recognizing that decades of monetary expansion created enormous concentrations of paper wealth unsupported by corresponding growth in physical, collateral, or productive capacity, and when confidence in debt-backed liquidity weakens, capital historically migrates toward assets perceived as scarce, durable, and universally recognized as stores of value, which explains why physical precious metals continue attracting institutional interest, even during periods when mainstream financial commentary dismisses them as outdated relics. While behind the scenes, bullion inventories in major trading hubs have experienced recurring delivery stress, unusual outflows, and increasing demand for allocated storage structures, suggesting that sophisticated market participants may already be positioning for tighter physical supply conditions in the years ahead, especially if regulatory pressures continue discouraging excessive synthetic leverage within bullion markets. And this possibility becomes even more significant when considering that global mine production growth remains relatively constrained, while industrial demand for silver and strategic metals continues expanding rapidly due to electrification, renewable energy infrastructure, semiconductor manufacturing, and defense technology requirements, creating a potential collision between rising physical demand and a financial system increasingly forced to acknowledge the limitations of paper-based commodity exposure. Perhaps the most underestimated aspect of Basel III is the psychological impact it carries for institutional capital, because regulations often shape market behavior not only through direct requirements, but through the expectations they create regarding future systemic priorities, and by elevating the regulatory standing of allocated physical bullion while imposing heavier burdens on unallocated exposure, international banking authorities effectively signaled that tangible reserve assets may once again play a more central role within the architecture of financial stability, collateral management, and liquidity preservation during periods of economic stress. And once that perception begins spreading across hedge funds, pension institutions, sovereign wealth funds, family offices, and private banking networks, the resulting behavioral shift can become self-reinforcing as more participants seek direct ownership of scarce physical assets before broader market awareness intensifies competition for available supply, particularly because precious metals markets remain relatively small compared to the scale of global bond markets, sovereign debt exposure, and institutional capital pools, meaning even modest reallocations from traditional financial assets into physical bullion could produce disproportionately large effects on pricing, liquidity, and delivery dynamics, especially if confidence in fiat stability continues eroding amid persistent inflation, geopolitical conflict, and deteriorating fiscal discipline among major economies. The broader historical context makes this transition even more profound, because throughout monetary history, periods of excessive debt expansion and declining currency confidence have repeatedly culminated in the restoration of tangible reserve assets as anchors of financial trust, whether through formal gold standards, commodity-linked systems, or unofficial market-driven revaluations of hard assets relative to depreciating fiat currencies. And while modern policymakers publicly maintain confidence in the durability of the current monetary framework, institutional actions increasingly suggest preparations for a less certain future in which reserve diversification, physical collateral, and strategic commodity ownership become essential components of systemic resilience, and Basel III fits directly into that evolving landscape because it quietly reintroduces physical discipline into a financial architecture that for decades prioritized leverage, derivatives, and synthetic liquidity over tangible reserve integrity, thereby forcing banks to adapt to a world where real assets once again matter more than paper promises. And if this transformation continues accelerating, the long-term implications could extend far beyond precious metals markets alone, potentially influencing the future direction of global reserve currency dynamics, sovereign debt credibility, banking stability, and the balance of financial power between nations capable of securing strategic physical reserves and those still dependent primarily on debt-driven monetary expansion. The most critical question facing global markets is no longer whether Basel III matters, but rather how far its consequences will ultimately extend once the banking system fully internalizes the regulatory and strategic implications of prioritizing physical reserve integrity over synthetic leverage. Because history demonstrates that financial systems rarely transform through sudden public announcements alone. Instead, the deepest shifts occur gradually beneath the surface as institutions quietly reposition balance sheets, alter collateral preferences, strengthen reserve quality, and prepare for conditions they believe are increasingly probable. And within this evolving landscape, Basel III appears to represent a foundational component of a broader monetary realignment already unfolding across the international financial system, particularly as central banks, sovereign institutions, and major commercial banks accelerate efforts to secure tangible assets capable of preserving confidence during periods of elevated volatility, inflationary instability, and geopolitical fragmentation, while simultaneously reducing vulnerability to counterparty risk embedded within highly leveraged paper markets that depend heavily on perpetual liquidity and public trust to remain functional under stress. And this strategic repositioning becomes even more significant when viewed alongside the unprecedented debt burdens now weighing on nearly every major economy, where governments continue financing deficits through expanding monetary issuance despite weakening productivity growth, rising interest expenses, and increasingly fragile fiscal sustainability metrics that threaten long-term confidence in sovereign debt markets themselves. At the center of this transformation stands physical gold, because unlike fiat currency, sovereign bonds, or digital financial instruments, allocated bullion carries no default risk, no political liability, and no dependence on the solvency of another institution, making it uniquely positioned to function as a stabilizing reserve asset during periods when trust in traditional financial structures begins deteriorating. And Basel III effectively acknowledged this reality by assigning favorable treatment to properly allocated physical gold holdings while imposing more restrictive funding requirements on unallocated exposure, thereby encouraging banks to move closer toward tangible reserve ownership rather than synthetic derivatives-based participation. And although the transition remains gradual, the cumulative effect may eventually become extremely powerful because even a modest institutional shift away from paper leverage and toward physical acquisition could strain available bullion supplies given the enormous scale of global financial assets compared to the relatively limited size of the precious metals market, especially when considering that much of the world's physical gold is already held by central banks, sovereign entities, long-term investors, and private wealth structures unlikely to liquidate holdings easily during periods of monetary uncertainty, which raises the possibility that future market stress could trigger intense competition for deliverable physical inventory at precisely the moment when confidence in paper substitutes begins weakening. This dynamic becomes particularly dangerous for the traditional bullion banking model because the paper precious metals market has historically depended on the assumption that only a small percentage of participants would ever request physical delivery simultaneously, allowing institutions to operate with leverage ratios that under normal conditions appeared manageable but under stressed conditions could expose severe structural vulnerabilities if confidence rapidly shifts toward allocated ownership. And Basel III increases the probability of such a transition by gradually reducing the economic attractiveness of maintaining large unallocated liabilities without stable funding support, thereby pressuring institutions to either secure additional physical inventory or reduce exposure to synthetic positions altogether, while, at the same time, rising geopolitical tensions, sanctions risk, reserve asset weaponization, and de-dollarization efforts continue encouraging nations and institutions to diversify reserves into politically neutral tangible assets beyond the reach of foreign governments or centralized financial networks, reinforcing demand for physical bullion across multiple layers of the international system simultaneously. And this convergence of regulatory change, sovereign accumulation, and declining trust in debt-backed monetary expansion could ultimately create conditions where the repricing of precious metals becomes not merely a speculative event, but a reflection of a deeper reassessment of financial credibility itself. Equally important is the psychological message Basel III sends to institutional investors, because markets often respond less to official statements than to the incentives embedded within regulatory structures. And when global banking regulators begin treating allocated physical bullion as a premium quality reserve asset while penalizing leveraged paper exposure, sophisticated capital interprets that shift as an indication that systemic resilience increasingly depends upon tangible collateral rather than purely synthetic liquidity mechanisms, encouraging pension funds, sovereign wealth managers, family offices, and multinational corporations to reconsider the role precious metals may play within long-term capital preservation strategies, particularly in an era where inflation remains structurally elevated, sovereign debt burdens continue expanding, and confidence in traditional reserve currencies faces mounting pressure from geopolitical fragmentation and competitive monetary policies. And once this reassessment gains momentum, the resulting capital flows into physical bullion markets could become self-reinforcing because rising demand would likely tighten available supply, strengthen delivery premiums, and expose the limitations of heavily leveraged paper pricing structures that have historically suppressed volatility through synthetic volume expansion rather than genuine physical liquidity. Ultimately, Basel III may be remembered not simply as a banking regulation, but as a quiet turning point in modern monetary history because it marks one of the first major regulatory acknowledgments that the post-1971 financial order built primarily upon debt expansion, fiat liquidity creation, and derivative leverage requires stronger foundations of tangible reserve integrity to remain credible in an increasingly unstable world. And while the transition away from purely paper-driven finance will likely unfold gradually rather than through immediate systemic collapse, The direction of travel appears increasingly clear as institutions around the world continue strengthening physical reserves, reducing dependence on vulnerable synthetic structures, and preparing for an era where trust alone may no longer sustain the scale of leverage accumulated throughout the modern global economy. And if that process accelerates under the pressure of inflation, geopolitical conflict, banking instability, or sovereign debt stress, then the competition for physical gold and strategic tangible assets could intensify dramatically, potentially reshaping the balance of financial power between nations, redefining reserve asset priorities within the banking system, and triggering one of the most significant monetary transitions witnessed since the collapse of Bretton Woods, with Basel III standing at the center of the transformation that quietly forced the world's banks to recognize that in times of systemic uncertainty, physical assets ultimately matter more than paper promises.